3170. We're looking into financial assets and financial liabilities. Let's make sense of this particular reading and let's get a strong understanding about this. What about financial assets and what about financial liabilities? So looking into financial assets and liabilities, let's get a strong understanding about what it comprises of. So financial asset is, guys, any asset that creates a right to receive cash, right? Any asset that creates a right to receive cash is called as a financial asset, right to receive cash. Financial liability is any obligation towards the financial asset. Any obligation towards the holder of a financial asset. Okay. So asset, the right to receive cash. Financial asset is when you have a right to, for example, if I have a share of a company, I have a bond of a company, I have done a credit sale, right? I have a share of a company, I have a bond of a company, I have done a credit sale in a company. Okay. So in all these cases, guys, I have a right to receive the cash, right? So in share, what is that my right to receive here, Indrani? Shares, mein, what have my right to receive?
The shares in turn of the money which you will pay for buying the shares.
I get the shares. Shares आ गया मेरे पास. शेयर से मेरे पास आज डिविडेंड मिलेंगे. बॉन्ड से क्या मिलेगा?
Interest.
इंटरेस्ट मिलेगा. और क्रेडिट सेल किया हूं तो क्या मिलेगा?
Credit sales.
कैश मिलेगा ना? अगर मैं क्रेडिट पे बेचा हूं किसी को तो डोंट यू थिंक आई हैव अ राइट टू रिसीव दैट कैश?
Okay. Yes.
है ना? पर अगर मैंने एक मोटर कार खरीद लिया, इज इट क्रिएटिंग एनी राइट टू रिसीव कैश? सिर्फ गाड़ी खरीद लेने से कैश आता है मेरे को कुछ, और मैं कुछ भी नहीं करूं, सिर्फ खरीद के रख दूं, कैश आएगा? नो. तो दैट इज द डिफरेंस बिटवीन अ नॉर्मल असेट एंड अ फाइनेंशियल असेट, राइट? मोटर कार असेट है, बाकी तीनों फाइनेंशियल असेट है. The motor car is an asset, the other three are financial asset. Financial asset is an asset that creates a right to receive cash in the future. Okay, so any asset that creates a right to receive cash in the future is called as a financial asset. Okay, any asset that creates a right to receive cash in the future is a financial asset. And then financial liability is an obligation to pay towards the holder of a financial asset. Okay, financial obligation is a right to pay to the holder of a financial asset. That is called as a financial liability. Okay, did you understand what is financial asset? It creates a right to receive cash. Okay, it creates a right to receive cash. Normal asset does not create a right to receive cash, right? Me purchasing a motor van, motor car, purchasing any other similar non-current assets, right? It does not create a right really. It may, if I work out it and I can make some money out of it, is okay, but it's creating a right, right? I have a right, right? I have a right to do this, right to receive cash. Only these three. Okay, and obviously there might be way more instruments under these, but high level, these are the three instruments that create a right to receive cash. So any financial asset is any asset that creates a right to receive cash. Financial liabilities basically is any obligation towards the holder of a financial asset. Right, towards the holder of a financial asset is called financial liability. Any liability towards the holder of a financial asset. Any liability towards the holder of a financial asset is a financial liability. Okay, so we look into various things here. So first we will study financial assets, and we will study financial liabilities, then we will study equity, and then we will study debt. And firstly, financial instruments. Okay, let's get started. So quickly, guys, what is financial instruments? Financial instrument is a contract that creates a financial asset in one party's book and creates a financial liability in another party's book simultaneously in one transaction. Simultaneously, right? So what is a financial instrument? It is a contract that creates a financial asset in one party's book and a financial liability in another party's book simultaneously. That is called as a financial instrument. It creates financial asset in one party's book, financial liability in another party's book simultaneously. That instrument is called as a that contract is called as a financial instrument. Right? So what is financial instrument? It is a contract. And what does it do? It creates financial asset in one party's book, financial liability in another party's book simultaneously. And that kind of an instrument is called, that kind of a contract is called as a financial instrument. Okay, did you understand what? Moving on now, these are the various accounting standards that we will study, guys. These are the various accounting standards that we will study. right, over the course of the chapter. Coming to financial asset, what is financial asset? Right. So first of all, it is an asset that creates a right to receive cash. It's an asset that creates a right to receive cash. Okay. So any asset that creates a right to receive cash is called as a financial asset. These are all the examples. Okay. Next, what is financial liabilities? Again, it is an obligation, right? It is an obligation. Okay. Please make these notes, guys. It is an obligation to pay cash to the holder of a financial asset. Okay. These are the examples. Okay. So we understood what is financial asset. We understood what is financial liability. Okay. We looked into the accounting standards over here. We looked at in general what is a financial instrument. Financial instrument is done. The various accounting standards that we will study over it anyway be covered, so you'll get it like that. What is financial asset example? What is financial liability example? Okay. So now there is an illustration here giving us the example of all these things. So see, if I just purchase an inventory, it's not going to give me any cash in the future. I purchase shares, I will get dividends. Right? If I purchase shares, I will get dividends. Right? If I prepay for goods and services, I'm not going to get any cash. Liability for income taxes, again, it's not a financial instrument. And a share option is a financial instrument because since the contractual obligation exists to deliver, we studied a share option that we have to deliver a equity to somebody. Right? Yesterday we studied the share options. You remember share option that anyone can buy the share option at a lower price. I can buy the shares of a company at a lower price. So share options and shares, right? Share options and shares. So if you look into shares and share options, right? Share options and shares are what? Financial instruments. Which two are financial instruments? Share options and shares. Right? Because in shares I'll get dividend, share options, I can demand to get a share later on. Obviously I'm paying, but again I have the right to get it at a lower price, right? It's giving me a right to receive, right? And that will eventually give to a dividend as well. So inventory is not, okay. So inventory is not, okay. A share option is a financial instrument. Liability for income taxes is not, and prepayment for any goods or services is not. This is not a financial asset. Shares and share options are, financial instruments. Share and share options are financial instruments. Okay, quick revision on this. Shares and share options can be a financial asset that creating a right that I can receive cash in the future. Okay, so now what we have done is we have completed financial instruments. The topic of financial instrument is completed. Now we are starting financial liabilities. Okay, so now the topic that we are looking into is financial liabilities. So when I look into financial liabilities, initially it is at fair value, right? And how do we get that fair value? So I have borrowed cash from somebody, right? Fair value of the proceeds of the cash. So I borrowed 10 lakhs. Okay. And I had to issue debentures for that. Issuing the debentures costed me 1 lakhs. So I will record my liability at 9 lakhs. Okay. So it is always at the net, right? Cash received less any cost of issuing that liability, right? We'll record the financial liability at 10 lakhs minus the issue cost of 1 lakh. 10 lakh minus the issue cost of 1 lakh at 9 lakh. That is called financial liability. Initially, we recognize that fair value less issue cost. Okay, share fair value less issue cost. Okay, initially we recognize it at fair value less in issue cost. Subsequently, what do? We make that amortization table. As you know, we take the opening, we add the effective interest, and we subtract the interest that is paid. That's it. One is the interest that accrues, and one is the interest that is paid, and that will give the closing liability for the year. Right? We have just done this in leases also. You take the opening, increase it by the effective, reduce the interest paid, and that gave us the closing. Closing went to balance sheet, interest, the expense that is accrued went to P&L, what I paid went to cash flow. The effective went to P&L, what I paid went to cash flow, closing went to balance sheet. Opening didn't go anywhere. Okay, done. Subsequent measurement, right? Initially at fair value less issue cost, subsequently at this table. Subsequently using this table. Okay, immediately let's look into a number here. Okay, so here they are telling us the issue of a loan is 1000. Okay, so you see the issue of the loan was 1000, right? So it's 1000 we have taken here, issue of a loan 1000. Yeah, the loan is redeemable means you have to repay it in 5 years at a premium of 250. So when I repay in the last year, I will pay 1250. Clear with this, buddy? I take a loan of how much?
1,000.
When I pay how much, I'll pay
1,250.
250. Okay. At a premium 250. This is also accounted for. Interest of 5.9 is paid at the end of each year. So how much I'm paying? 5.9 of 1000. 5.9 of 1000. So I'm paying 59 every year. Year 1, year 2, year 3, year 4, and end of year. So full year interest I'll pay. 5 payments I've made. 5.9. Effective rate is 10%. Right? Effective rate is 10%. So, but if I were to purchase it from the market, right? If I had not invested in this company but invested in the market, I would get 10%. But how much is this company giving me? This company is giving me 5% every year. In the last year, it's giving me a balloon payment to compensate for the fact that it's unable to give me at the market rate. Right? So how much was due? How much they told they will give me that year? The agreement was that they will give me 10%. But because of the business conditions right now that is happening, they are only unable to give me full 10%. So they give me 5.9% only. So whatever they have not given me, that I carry forward. The next, again, they should give me 10% of the carried forward, but they only give me 59. So whatever they have not given me, that's carried forward. That's carried forward. In the last year, they give me a balloon payment, that 250. It compensates for all the other, every year that they had not given me the shortage, it compensates for that. Right? So this 10%, the effective rate, it's called as the effective rate, the 10%. Right? This is what it was agreed, that they will pay me 10% every year. This was the agreed. But due to business issues, right, the business conditions, they were not able to pay me the full amount. Fair. But whatever they didn't pay me, they allowed me to carry it forward. So I carried forward. And in the last, what they did was they gave me a balloon payment in the last. The 250 is a balloon payment, right? And that compensated for all the years that they were unable to pay me. That compensated for all the years they were unable to pay me. Okay. So in this case, the total of all the interest that goes to P&L, the total money that we have paid on a yearly basis that goes to cash flow, and all this is the closing in the balance sheet. Okay, so I gave 1,000 rupees to them. They told they'll pay me 10%. So how much they should have paid? 100. But how much did they actually pay? 59. So the net of the two, how much is carried forward at the year end? 1041. This gets to the next year. How much should they pay me? Promised was 10%. Right? The only difference is effective rate is calculated 10% of the opening. Right? You see the effective is calculated as 10% of the opening. But the interest paid, the coupon, every year the interest that is paid, that is fixed at 5.9% of the loan amount. Okay, what I'm fixed paying is 5.9% of the loan amount, 59, 59, 59, 59, 59. This is fixed. What I'm paying is fixed. But what I've promised, that will be 10% of the balance brought forward at that year. So this 10%, guys, again you see is calculated at the opening balance at the start of the year. It's based on this opening balance. But this 59 is based on just one number, that is the 1000. So what you pay is fixed. But what is accrued every year is 10% of the opening amount. Okay, and whatever was unpaid, that gets carried forward. And in the last year, a balloon payment is made to compensate for everything. Okay, so let's do one more here. 5% loan notes. So this is the 5 they will pay every year. 5 of 20,000. I think 1,000 they are paying every year. 50, 10% हो जाता 10,000, 5%, 1000. कितने साल का? 31st December 2006. So 3 full year, 4 full year, 5 full year, 6 full year. Okay, 3 full year I'll keep the money, 4 full year, 5 full year I'll keep the money, 6 also full year I'll keep the money. 4 years, I will pay 1,000 every year. इतना मैंने repay कर देना. Okay, how much loan I had taken? 20k. So this was at 5%. This is the opening. And what is the effective rate of a year? Effective rate is also 5%. So there will be literally nothing carried forward every year. So I'm paying at par. So no problems only. So 5% of 20, 1,000. I should have paid. How much did I actually pay? 1,000. What is carried forward? 20,000. Then again that gets carried forward. 20,000. Plus how much would I pay? 5% of the opening. Minus what I actually paid, 1,000. Nothing is carried forward. Again carrying it forward to next year. Plus what should I pay? 5% of that. What I actually paid, 5% of that only. 20,000 only is carried forward. Last year, Nothing is carried forward. 4 years later, by the end of 4 years, I would have paid all the money. Right? And the last year I paid 20 also. In the last year I've paid the 20 as well. In the last year 1000 I've paid, but I've paid 20,000 also. What is carried forward? Nothing in that year. If I paid it at the end of the 4th year. No, repayable on 31st December 2006. This is 2003, 2004, 2005, 2006. Right? This is the start of the year, January. This is the end of the year, December. Clear? Okay. So I'm paying 20K also at the end of the year. Okay. So there's effective rate, which is calculated as the percentage of the opening. Then we have the coupon that is calculated as the percentage of the loan amount. This is paid every year. This will be at the percentage of this. That's it. Okay. So then now the others I will just show it to you. Now that you have got the format, let's not unnecessarily waste the time. Yeah, let's look into this. अभी जो किया 20 20 20 20 opening effective rate coupon rate. Effective rate 5% of opening 1000. How much did I pay? 5% of 20,000. What is carried? 20. Next again 20 is carried, 5% of opening, then 5% of the loan amount. This last year I paid 1000 20,000, nothing is remaining. That's it. Yeah, are you clear with this?
Yes.
Okay, next one here. On 1st January, an entity issues 0% loan note. So a coupon I will pay 0. Every year I will pay 0 at the nominal value of 40,000. Okay, so opening is 40. Okay, so opening is 40. Okay, my coupon every year is 0. Okay, 0% loan notes. At the nominal value, loan notes are repayable at a premium of 11,800. So when I pay, I will pay 51,800. I've taken how much? 40. But when I pay, I will pay how much? 51,800. And the effective rate is 9%. How much gets accrued? At 9% of opening. This is the closing of that year. Carried forward plus 9% of this. Or carried forward plus 9% of this. Nothing paid again. 51,800 paid. Everything 0. Right? So the effective is a percentage of the opening and the cash paid is a percentage of the it's called as the coupon. One is the effective, one is the coupon. This is the effective. This will be a percentage of the opening. Coupon is a percentage of the loan amount. Fixed. This is called as coupon. Effective will be mentioned, automatically the other one becomes coupon. So you have to just see if effective written is there, is written here. So therefore effective rate. So effective will be clearly mentioned in the question. The other one we will figure. The other one has to be coupon. There's no need for any other rate. Okay. Okay, next one, final. On 1st January 2002, an entity issues 4% loan notes. What is this, guys? Effective or coupon?
Coupon.
Coupon. Okay. So nominal value 20,000. This is your loan amount 20,000. Right. So 20,000 is my loan amount. Coupon is 4%. Right. And they're telling premium effective is 7. And that will repaid at a premium. I will repay at a premium. Okay. So just as we are reading it, I will show it to you on the table. Okay. So opening coupon should be 20,000, but it is not 20,000 here. Because initially we recognize it net of what? What would we subtract, guys? Anybody?
Discount.
What did we subtract? What was the word?
Discount.
Issue cost. Remember? Fair value minus issue cost. I have written it. Initially, how do we recognize it? Can we see fair value less issue cost? Initially, we recognize that fair value less issue cost. Yeah.
Yes.
Fair value less issue cost. Before doing any sum, we have written it down. Before doing any sum, the rules were laid down. So in this sum, have they given issue cost? Yes. They are issued at a 2.5 discount and a 534 of issue cost. Right? You see 534 of issue cost. Okay. So as we had studied, we have take the 20,000 and 534 issue cost. We have removed it. Now we'll get to the discount because I'm just telling reference to what we had already discussed. Issue cost or something before I started, even one sum we had discussed this. So 534 issue cost is subtracted. Along with that, we got a discount that is subtracted. So at 1896, we have the opening. Any questions here, guys, on the opening? Three numbers I've used for the opening. Any questions here? Okay. So now that I have the opening, next I need the effective to multiply with the opening. Effective is given 7%. 7% of this, I got this. Then I need the coupon. Coupon will be on the loan amount. Always on the gross loan amount, on the gross loan, 20,000, 4%, 800. This is what I paid. This is what is pending. This goes to your balance sheet, closing liability. This goes to your cash flow statement, interest paid. This goes to your P&L. This goes nowhere. This is your previous year closing. That's it, done. And your discount and issue cost also is expensed off. No, it's removed here. It is removed from this 8996. Removed from this. That's it. Okay. See, this number right now we don't need because we don't need to make the entire table. Had we needed the entire table, we would have taken this 10% in the last year. If we needed the table. Right now we're not making the entire table. Only for 1 year if we're making, we get this. Had we made the entire table, we would need it for the entire table. That's it. Okay. This is your financial liabilities, all the sum done. Initial recognition done. The table you have understood. Zero coupon you understood already. That redeemed discount bond issued at a discount. Have we not issued it at a discount? Right? Issued at a discount here. Zero coupon. There is no coupon only. We did that also one sum. No coupon. This is your zero coupon. Zero coupon also now you know how to do. Zero coupon. And now discount bond also you know how to do. How to do with the discount. Just one place you have to subtract. Yeah. That's all. Zero coupon also discount. Issue cost also you know now how to treat. All the sums I've done. Yeah. Clear, buddy? Yes. Yeah. Have you understood this here, Arpita?
Yes, sir.
No. So that is again opening done over here. Again, making your notes simultaneously. Deep discount bonds again. All this deep discounts is removed from proceeds. From the proceeds, I will remove. Okay. And this is like my similar to amortization table. Okay. So bus again, you just have to make table. Opening, effective, coupon, closing. Closing, balance sheet, coupon, cash flow, effect, expense, P&L. That's it. Done. Same applies for everything. Okay. हो गया बस financial liability. Now let's go to preference share. So see, irredeemable preference share is equity, right? Irredeemable preference share is equity, but redeemable preference share is liability. Imagine something that has shares in it and it is a liability. Imagine something that has shares in it and it is a liability. It has the word shares in it. So any redeemable preference share is always a liability. Irredeemable preference share is equity, no problem. Okay, if it's irredeemable, it is equity. Irredeemable is equity. It's redeemable, it is a liability. The key element is that there is an obligation, the instrument represents a liability. That here there is an obligation to repay at a fixed time. The key element is obligation. Okay. So it's a redeemable preference share, it's a liability. Irredeemable preference shares is a normal equity. Um, Now, preference shares, equity shares. Sorry, preference shares redeemable, preference shares non-redeemable. Preference shares, redeemable preference shares, irredeemable preference shares. The accounting treatment of interest and dividend depends on the accounting treatment of the instrument. Equity dividends are declared, are directly reported in equity. So see, irredeemable preference shares is an equity instrument, but any dividends is also will be recorded in equity. Redeemable preference shares is a liability. So any dividends on that will go to P&L, right? So any payment will depend on the classification of the instrument. So see, any dividend, this is instrument. This is the classification, right? So where will the payments be recorded? Where will the payments be recorded depends upon the classification of that instrument. If it's a liability, you record the payment in P&L.
Yeah.
If it's an equity, record the payment in equity.
So the liability should record in balance sheet.
The liability will go to balance sheet, but any payment from that, like for example,
Interest,
exactly, that's what the heading is. You see the heading, interest and dividends. This is not about the instrument, it's the payment from the instrument. We are talking about the payment from the instrument. We're not talking about the instrument. It's payment from the instrument, any return from that instrument. Okay? And look into some here. So on first April, entity issued 40,000, right? 40,000. One was the redeemable preference share. Redeemable means what? Liability. Liability means how you do initial treatment is that fair value less issue cost, and subsequently you'll make the amortization table. Same thing, right? Because it's a liability. Liability, you know how to treat. Okay. So 40,000, 40,000. The redeemable preference shares with a coupon rate is 8. So coupon is already given 8%. So 8% of this 3,200 negative. They are redeemable at a large premium and gives an effective rate of 12. So 12% effective. So 12 of this. So add the 12, subtract the 3, you got your closing. Carry the closing forward again. Add this, subtract the 3, you got your closing again. Right? So this is your 2 years closing. And this is your 2 years finance cost. And if you made a cash flow statement, this would have gone in the cash flow. That's it, finished. Even though it was a preference shares, you've treated like it as a liability. Imagine you have treated a share as a liability. That is why, if you see, if anyone who had just you just really understood this, the point is, why are you treating a share like a liability? Right? Imagine this is a share. A share is being treated as a liability because of the obligation. Treating the share like a liability. Treating the share like a liability. Yeah. You're treating the share like a liability. Okay, it's okay. Yeah. You're treating the share like a liability. Why? Because of the obligation. Right? Because redeemable preference share means the repayment date is fixed. That's why it's called redeemable. Okay. Next, देखते हैं compound instruments. Okay, compound instruments very easy. Let's quickly look into a sum. Everything else will naturally make sense. Okay. So, covert co issues a convertible loan and pays an interest of 2% annual in arrears. So, कुछ भी नहीं लिखा हुआ है. That means it's coupon. How much it pays? 2% it pays. How much it pays? 2%. We have made this a reference page.